Welcome to the first quarter 2025 webinar from Wespath. My name is Joe Halwax, Senior Managing Director of Institutional Investment Services, coming to you from our offices in Glenview, Illinois. I want to thank all of our clients for your partnership and your trust in Wespath to steward your assets and support your missions. We know there's anxiety given the stock and bond market volatility, and as your partner, we'll continue to communicate frequently with webinars such as this and regular updates. Wespath is here for you, and if you have any questions, please reach out to your Wespath relationship manager. We've got a great webinar for you today. First, I'm joined by my colleague, Quach, Wespath's Director of Public Markets. Quach and I are going to attempt to make sense of what's been a wild 3.5 months to start this year. We'll cover the major headlines from Q1, and we'll dive deep into the tariff tantrum of early April. After that, Karen will join me to review fund performance for the first quarter. And we'll conclude with a great segment from our impact investing team, Sylvia and Trent, highlighting a new investment strategy focused on positive impact in Africa. As always, all these segments are available together or individually on our website. Before we begin, a reminder on our quarterly investor letter. In this quarter's letter, we dive into the market's reaction to tariffs and the Trump administration's emerging economic agenda. Beyond just the tariff headlines, we try to examine more of the bigger picture, explaining what major economic changes this administration might be trying to make and how that might impact markets. We also highlight our client asset allocation committee and explain how we try to build customized client portfolios that can weather various market conditions, including the volatility that we've seen this year. You can read the letter by scanning the QR code. Finally, our Chief Investment Officer, Johara, shared even more about the context of tariff-induced volatility in a brief note to investors last week. Johara gave a great breakdown of what happened and what seemed to cause it, and she explained how it impacted Wespath's investors. A major theme here was the opportunity for institutional investors with long-term focus. Though the volatility was significant, and though we still face questions on the true impact of tariffs, we've seen stock markets rebound from even the most monumental moments. Johara explains more in her note, which you can check out via the QR code here now. Now let's get on to the webinar. I'm joined now by our Director of Public Markets, Quach. We are going to change it up today and talk about the first quarter and then also talk about the first 2 weeks of April. This has been one of the more volatile periods of my lifetime, along with the dot-com bust, Lehman and the Great Financial Crisis, and COVID, a fourth major market event. Well, welcome. Perhaps you can start with how we got here.
Great. Thanks, Joe. You mentioned COVID. That's where I'm going to start. About 5 years ago, almost to the day, we had COVID, the lockdown. And if you remember back to that time, there's a lot of uncertainty and a little bit of panic, right? And so we saw stock markets collapse around the world. The Fed and other central banks reacted to this by slashing interest rates to near zero. The federal government got into the act and enacted fiscal stimulus measures to provide the economic relief. I think the CARES Act was to tune of like 2.2 trillion, Joe. I mean, that provide direct payments to individuals, expand unemployment benefits, pause student loan payments, just a variety of things. But it was quite a bit of money put into the economy. And as vaccines rolled out, the lockdowns lifted. We had pent-up consumer demand, global supply chain issues, and of course, all that money floating around from the stimulus. That really increased inflation. For about 20 years, we've been averaging inflation around 2%. And depending on what measures of CPI you're looking at, it got up to like 7 to 9% post-COVID. And sort of that was, inflation. The Fed at first was like, it's transitory. We're not going to do anything about it. And then once they realized maybe inflation was kind of here to stay, they started hiking rates. We saw some of the highest and quickest rate hikes in the last 40 years. So in that period from 2022 to 2023, we saw rates go from near zero to 5.25%, 5.5%, which leads us to today. One of the things I didn't mention was the rise of AI. Yeah. I mean, that definitely had, some of its roots in the COVID response, as we went through this digital transformation.
Jumping on Zoom all the time.
Yes. And going back to the stimulus, there's all this money, zero, very low interest rates. So there's a lot of investment in technology. So that really helped to ramp up this AI development. And that has been such a major impact on the stock market the last few years.
And the Mag 7 really took off from January of 23 and was a story we've talked about quite a lot.
Definitely. And, we still see high interest rates. They're still there. Inflation still is high. And then, it may be rising. And one of the causes of this increase or continued inflation is tariffs, which are starting to play out. And we actually don't know the full impact of that yet, but that's something that's really on top of mind right now.
All right, so that's a great background to talk about the recent drivers of the economy. And what we're going to do now is we're going to borrow a chart that we used at the conference forum yesterday. This gives us some further color. This talks about where we were, say, post-financial crisis in the 2010s, and then where we are today, kind of teeing it up for investors to think about the differences. So we've got here secular and cyclical drivers. And how about you take cyclical and I'll take secular? But just so the audience knows, cyclical are more short-term and tied to the economy, and secular are more long-term and less impacted by market swings. I like to think of like cyclical is like a vacation, something you're going to cancel if the economy is weak, versus secular, that's like a doctor, you're going to go to the doctor no matter what. So what do you think about the cyclical today and how we stand?
Right, Joe. Just for comparison, you look at the 2010s, we are coming out of the global financial crisis. So, growth was steady, but, a little bit on the lower end, around 2.3% at that time. We had inflation was low, it was around 2%, and the Fed policy was pretty easy money. I mean, interest rates were near zero
Cheap.
During that time. And then we get to today, as I talked about, post-COVID, things are a little bit different. Coming out of COVID, all that pent-up demand, we had really strong growth. I think we were approaching 6% at one point in 2021. But it's been moderating. The last few years, we've seen sort of a slower decline in growth rates, still above what we saw post-GFC, but more in the 2.6, 2.8 range. But the outlook for 2025 is a little bit lower than that. We're going back to sort of the 2.3% growth that we saw post-COVID or post-GFC. Inflation, well, we talked about that. It still remains high. It's definitely above target. And, we'll see where that goes. But I don't see it getting back to the low inflation that we saw in the 2010s anytime soon. Fed policy, we're still seeing high Fed funds rate or higher than zero. So that's where we are today.
And quantitative tightening. Well, then looking at the secular drivers, so geopolitical risks are elevated. I think that's and globalization is retrenching, probably accelerated in the last 3 months. The business backdrop is reasonably supportive. AI, as we kind of talked about, positive. Valuations are in question, and energy is also a question. I think it'll depend on this administration. But I think to take the broad, looking at the columns on the left and the right, on the left, these columns are a lot of green, meaning a lot of tailwinds. And on the right, we've got yellow and pink, meaning that we're trying to say is there's more headwinds to the economy and even to asset prices now in terms of both policy and valuations than we had, say, 10 to 15 years ago. So now we've gone over the past 5 years and then teed up a little bit of what 2025 looks like, versus the past history. We know what you're thinking. We want to talk a little bit more about tariffs and client questions, but we're going to quickly review fixed income and equity performance for the first quarter. So why don't I start with equities? What we can see on this table here is something looks very different than the past 2 years. And you can see the mega cap portfolio down at the bottom at negative 15%. And what we saw during the year was the market topped out in roughly mid-February, and there was a large rotation out of U.S. stocks and into international stocks. So looking at the top here, you can see at the top is 4.6% is global stocks or international stocks, meaning that you saw a 15% rally in Germany and 15% rally in China. And again, leading up to the tariffs and leading up to some of the tariff anticipation, the rotation is something we haven't seen in quite a long time, but we'll talk more about how that's looking in April. But can you tell us a little bit about fixed income for the quarter?
Sure, Joe. So looking at fixed income returns for the first quarter, with yields falling, we were expecting bond returns to be relatively strong. The Bloomberg aggregate was just under 3% for the quarter. But given the volatility in March, the riskier parts of the fixed income, such as credit and high yield, were positive, but in the end, Treasuries still outperform at just under 3%.
All right, let's move on now to client questions, and Juan and I will take turns answering them. We're going to start with, are tariffs inherently negative for the economy and for portfolios? What I would say to that is a metaphor that we've used is a knife. A knife can be used to open up a package from Amazon. It can be used to open up the birthday card from your mother. A knife can also be used as a weapon. With tariffs in themselves are inherently bad. And in theory, the tariffs, as we've seen them in the last month, it's about the style and the methods, meaning the style by spreading tariffs across the entire globe, only to then focus on just China, and then the method of not negotiating in a back room, but instead negotiating on social media. And I think also, while there's also the thought of whether they're structural or whether they're used as a negotiating tool.
Right. And, if they are structural, we can expect inflation in the short term and maybe even for longer. And, perhaps growth is hindered as companies are, maybe holding back investment because of these tariffs.
I think the other thought on the structural side is, will we end up focused on certain individual items? Microchips, steel, lithium.
Right. I mean, definitely we saw the risk to not having, production of those,
During COVID.
During COVID. And so I there's, case to be made for that.
I think one of the other questions we're getting is how are the markets reacting with such volatility? My short answer to that was poorly, but Juan, maybe you can add a little bit of context to my.
Well, yeah, the market is priced for perfection, meaning that stocks are richly valued, credit spreads are low. In all reality, we may have had a correction without Liberation Day, but the way that these tariffs have been introduced, the on-off nature, pausing and increasing tariffs, I think that has just really introduced so much volatility in the market. And as we all know, Joe, the market does not love volatility.
Well, and thinking of the market and the volatility, let's talk about the reactions. One of the questions we are also getting is this market reaction in line with historical norms? And let me take a stab at this. Top to bottom, we've had 19% correction from the highs in Feb 19 to this week in the S&P 500. So we had a 28% correction in fall of 2022. We had a 34% correction with COVID. We had a 20% correction in fall of 2018, the last time we had tariffs. So unfortunately, 20%, 15 to 20% corrections happen once every roughly 4 years. They're always painful and they'll have varying triggers. The last question we're going to talk about is, as of today, April 11th, what is the latest news on tariffs today?
Okay, well, Joe, before we started this conversation, what we saw is that China hitting back with the tariff wars, raising their tariffs on the U.S. to 125%. Consumer sentiment has dropped to one of the lowest levels in a decade. Major stock indices have been negative, although a little bit more moderate than we've seen earlier this week. And with that spike that we saw on Wednesday, the S&P 500 is on track to finish the week in positive territory. Gold is at an all-time high. The U.S. dollar fell for a fifth straight day, while the euro has surged. And the 10-year Treasury yields increased to over 4.5%. And that's, as of this morning, could change by the end of the day.
I think it's worth mentioning, too, that some of these things are not necessarily expected. The dollar falling when we're introducing tariffs is kind of the exact opposite reaction you might have. And then bond yields rising, meaning treasuries are being sold, is also not the reaction we'd be expecting. So one of the challenges is that this is like kind of like maybe the other four big events that we've seen. This is a very unique situation, and we're not seeing markets react as they might have previously.
Sure.
Well, thank you for attending the webinar. Thank you for the questions. Please keep sending questions to Wespath. Please reach out to your representative if we can help you with anything further. We appreciate your partnership, and we look forward to seeing you at the next webinar. I'm now joined by my colleague, Karen Manczko.
Hello, everyone. On this segment, Joe and I will be talking about the attribution of the Wespath funds. To start things off, it's good to set the backdrop. Entering 2025, the U.S. economy was on solid ground with positive momentum. This was quickly soured by the threat of tariffs, which created an equity market correction, along with weakening economic data, which made investors fear of a looming recession and possible resurgence of inflation.
All right, so let's get to it. In another webinar segment, Hua, Director of Public Markets, discussed how the Magnificent Seven, which had been market leaders for years now, experienced a sharp sell-off. Some of that was due to the DeepSeek story we talked about. Our U.S. equity fund is underweight the Magnificent Seven. So Karen, how did the U.S. equity fund perform?
You're absolutely right, Joe. The Magnificent Seven stock underperformance was a positive contributor to the U.S. equity fund, as mega cap stocks were down over 15% for the quarter, which was one of the worst quarters on record for those stocks.
And how did active strategies in the U.S. equity fund hold up in this difficult and volatile equity market environment?
The performance of our active strategies were mixed. Some of the names that our active strategies invested in were negatively impacted by the tariffs and the AI sell-off. But the good news is that our U.S. equity fund composite outperformed its benchmark net of all fees by 27 basis points for the quarter.
All right, so let's touch on international markets. International equities performed much differently than U.S. equities during the quarter. So tell us a little bit about that and the impact that it had on our international equity fund.
It was a much different quarter for international than U.S., which provided a nice, quite different change. International markets had a strong quarter and ended in positive territory, with developed international equities up almost 7% and emerging markets up 1.7%. This surge in international stocks versus the U.S. was the widest margin since the 1990s. As you and Hua mentioned, there were some weak expectations with international markets, which led to depressed valuations, which really created this nice rebound that we saw. The main drivers for the strong international markets for the quarter were weakness in U.S. equities and investors seeking opportunities elsewhere, European equities having their strongest performance since the mid-1980s, and the U.S. dollar depreciation.
Thanks for that rundown on international markets. So based on what you just shared, it looks like the International Equity Fund Composite is up roughly 3.3%, but underperformed this benchmark due to stock selection by the fund's active managers. So Karen, is there anything you want to highlight from our active strategies that caused that underperformance?
We actually saw the fund's ethical exclusions, which are the securities we do not invest in due to their core business revenue, detracted in the International Equity Fund. Defense and aerospace companies performed well, up 35%. Therefore, not owning these names was a detractor. The fund's allocation to alternatives also detracted, which we know this asset class will have headwinds when we see strong public markets like we did internationally in the first quarter. Similar to the US, some of our active managers were impacted by the tariff noise, and they're waiting in certain countries, like China, which had strong performance in the quarter.
Great. Thanks for that, Karen. Now let's switch gears and move to fixed income. We saw that the equity markets had a pretty volatile quarter with a wide margin of returns between U.S. and international markets. How did fixed income and fixed income markets perform?
To set the stage for bonds, let's briefly highlight what happened in the bond market. During the quarter, we saw U.S. Treasury yields decrease across much of the curve, specifically in the belly, which, when yields decrease, this is positive for bonds. The Fed left rates unchanged, and inflation numbers in February slightly ticked up for the PCE, which is the Fed's preferred measure. With all of this in the backdrop, we saw Treasuries outperform credit, emerging market bonds outperformed developed market bonds, and investment grade outperformed high yield. With this said, the fund's overweight to high yield detracted, but issue selective by our active managers offset this. Therefore, the fixed income fund composite landed in positive territory for the quarter, up 2.5% and returning relatively in line with its benchmark.
And how did the Inflation Protection Fund perform?
The Inflation Protection Fund composite also ended the quarter in positive territory, but underperformed its benchmark. The fund has a 10% allocation to commodities, which helped its absolute performance since commodities outperformed most bond asset classes. But the fund's underweight to U.S. Treasury inflation-protected securities and overweight to global inflation-linked bonds and senior secured loans detracted. Before we sign off, I know in our webinars we primarily highlight the funds that we just showcased. But late last year, we launched the Social Values Choice suite of funds for institutional investors. We shared some details about that in our last webinar in the fourth quarter. And I thought perhaps we'd highlight those funds a bit for our viewers today.
Great idea, Karen. Our Social Voice Equity Fund is a global equity portfolio. It's passively managed by a firm located in both Philadelphia and North Carolina called Exponents. We have a video of the founder of this firm and our CIO, Johara, on our website. This is a great fund because it allows investors that would like a global equity indexed portfolio wrapped into one fund. It includes the same ethical exclusions as all of our funds, plus has a heightened focus on the environment and human rights. Notably, it's an ex-fossil fuels fund, so it does not invest in oil and gas companies.
We also have a social vice choice bond fund that is actively managed that has the same exclusions that we just highlighted. These funds allow our investors to create a balanced portfolio solution.
And last but not least, we want to remind our investors that we have a U.S. equity index fund that is managed to the Russell 3000, which is another fund option for our investors.
Thanks for mentioning that, Joe. We always emphasize our 4 core actively managed funds, but I think it's a helpful reminder that we have even more funds that can help be the building blocks of our client success. This concludes our prepared remarks, but before we go, it's important for our investors to remember the basics during times like this. As our CIO mentioned in a recent letter to our investors, maintaining a disciplined, long-term focus has always been and will continue to be an integral part of our investment process. This process is firmly grounded in policies and procedures that we are sticking to.
On behalf of everybody at Wespath, thank you for your partnership and thank you for tuning in.
Hello, everyone, and thank you for joining us. I am Sylvia Poniecki, Director of Wespath's Impact Investments Program. Today, I'm excited to talk about one of our values-aligned investments, and to do that, I've invited my colleague Trent to join me. Trent, would you mind introducing yourself?
Thanks, Sylvia. It's great to be here as well. I'm Trent Sparrow, the Manager of Impact Investments at Wespath, and my focus here is to identify opportunities that deliver both meaningful social impact and strong financial performance.
As many of you know, Wespath has a long and proud history of investing in affordable housing through our Positive Social Purpose Lending Program. And over the last 35 years, we've committed over $2 billion to this initiative, supporting the creation of more than 53,000 affordable housing units across the country. What might be lesser known is the work that we've been doing in the microfinance space. Since 2005, Wespath has deployed more than $80 million to support small-scale lending in underserved markets. And most recently, we committed an additional $5 million to be invested in this space over the next few years. So just like with affordable housing, we approach microfinance with a yes and fiduciary impact lens, which means we seek returns that are appropriate for the risk while also driving measurable, lasting impact.
That's right. And before we dive into the details of our most recent investment, I think it's helpful to take a step back and look at what microfinance investing really means. In general, we invest through experienced partners who operate on the ground in developing or emerging economies. These partners have deep local knowledge, and they lend directly to micro entrepreneurs, often with loans as small as $50 to $300. These small loans can make a huge difference. They help individuals start or grow a business, stabilize their household income, and create a more secure future, not just for themselves, but often for entire communities.
Which brings us to Shared Interests, one of our long-standing microfinance partners. Shared Interests is a nonprofit organization based in New York, but its work is focused primarily on supporting underserved communities in Southern Africa. The organization was founded in 1994 by Donna Katzen and a group of U.S. anti-apartheid activists and impact investors, all committed to dismantling structural inequality through financial inclusion. Instead of lending directly, Shared Interest provides loan guarantees to help local banks and financial institutions feel confident lending to Black entrepreneurs, farmers, and small businesses, many of whom would otherwise be denied credit. At Wespath, we've had a long history with Shared Interests. Our first investment with them dates back to the early 2000s. We're proud to be supporting their work once again, now under the leadership of Ann McMickle, who stepped in as executive director after Donna's retirement in 2022. Ann and Shared Interests and the rest of the team have been working persistently to continue honoring Donna's vision. And one of Shared Interest's more recent initiatives that I wanted to highlight is their HBCU Social Impact Leaders Project, which connects students from historically Black colleges and universities to career opportunities in sustainable and impact investing. Shared Interest is all about helping young Black entrepreneurs become global change makers, driving positive economic growth in their communities and beyond.
Yeah, Sylvia, was exciting. I was actually able to be part of a NASDAQ bell ringing ceremony with the individuals as part of that program. And the energy there at that ceremony was electric. It's a really, really neat program that Shared Interest has created. Stepping back to kind of our investment here at Wespath, before we get too far into the weeds, I just want to provide some background as to how Shared Interest operates and how they turn investor capital into community transformation. This is centered in a 5-step cycle. First, it starts with investors like Wespath. Our capital forms the base for the guarantees that Shared Interest structures. Then, Shared Interest partners with experienced program consultants, or as we like to refer to them in the investment industry, the boots on the ground, to identify and vet high potential entrepreneurs and small and growing businesses. Next, they work hand in hand with entrepreneurs to identify the right credit products and lending institutions, making sure they have access to capital that's aligned with their goals. Then comes the guarantee. Shared Interest structures a guarantee that bridges the gap between the lender and the entrepreneur, ultimately aligning the interests of the lender, the entrepreneur, and Shared Interest as the guarantor. Ultimately, this structure reduces risk to the bank and unlocks 5 to 8 times more capital than if Shared Interest just lent the money directly. Finally, with that capital secured, entrepreneurs are able to launch or expand their businesses, create jobs, and serve their communities. Over time, they repay these loans, and then the capital can be recycled to support more businesses. It's a smart, high-leverage model that's deeply rooted in long-term partnership.
Trent, thank you for that. One of the projects that really stands out to me is the Sia Tutfuka Chicken Co-op in Eswatini. It's a great example of both impact and resilience. The co-op was made up of 27 women who initially secured a loan to raise poultry. But shortly after they launched, the local market was flooded with inexpensive chicken imports, making their original business model unsustainable. Rather than give up, they pivoted. So they diversified into the popcorn production business and ended up building a successful business that supplies popcorn to schools and supermarkets across the country. And it's just a remarkable story that really illustrates the adaptability and determination we often see in these entrepreneurs.
I really appreciate the adaptability that story provides. I'd love to share another one with folks. This one comes from KwaZulu-Natal, South Africa. Shared Interest helped guarantee a loan to a bus company cooperative. This Black and female-owned cooperative formed through a merger of 2 local taxi associations and another local bus company. With Shared Interest guarantee in place, the cooperative was able to purchase 24 buses, significantly improving access to transportation for residents of underserved townships in the area. The impact was immediate and tangible. 55 new jobs were created. The region saw improved mobility, and the cooperative was positioned for long-term growth, all because the guarantee helped unlock financing that wouldn't have been available otherwise. This is exactly the kind of catalytic effect we hope to see in this type of investment, creating sustainable infrastructure, empowering local ownership, and expanding opportunity in historically marginalized communities. Shared Interest is what a solid values-aligned investment looks like. Measurable impact, responsible stewardship of capital, and a long-term vision for inclusive economic growth. We're proud of our partnership with Shared Interest and look forward to what the future holds for them and us as an investor in their organization.